Hello everyone. In this video we'll be going through some of the topics and concepts in Chapter 9, and this relates to tax credits. So tax credits generally are a dollar for dollar reduction in the amount of a taxpayer's obligation or tax liability. Unlike a deduction, where the value of that deduction is only worth the amount of the deduction times the taxpayer's marginal tax rate. Credits are different. Credits are calculated after the initial tax liability is calculated, that is, the tax is payable, and then credits are applied against that at a full dollar for dollar basis. So they're very important. So there are many different kinds of tax credits in the tax code. One is for child and dependent care expenses. This is generally designed for working taxpayers who have to pay dependent care expenses. A qualifying individual, that is to say that the folks who are the children in this case, would have to be under the age of 13, dependent on a spouse of the taxpayer who is incapable of caring for himself or herself, so that 13-year age limitation is waived if the dependent or spouse is incapable of taking care of themselves. So the credit is calculated as a percentage of the qualifying expenses. So in your text they have a table, a percentage table, that shows the percentage between 20% and 35%, and the value, the amount of the percentage would depend upon the taxpayer's adjusted gross income. Now the amount of the expenses that can be used to calculate this credit is limited to $3,000 for one qualifying individual, or $6,000 for two or more, so not more than $6,000. Here is a table you'll find in the text that relates to the dependent care expenses, and you can see the far left column, the adjusted gross income column, and then the limitation in the second column, and then the amount of percentage that is applied. And of course, the greater the income, the less is the percentage of those expenses that qualify for the credit. Another credit is for the elderly or disabled. And by the way, I'll be going through some examples of these problems, as I do and have in the past, in a second video, where I'll walk through some of these problems and the calculations. So the second credit we'll discuss is for the elderly or disabled, and it's equal to 15% of the allowable base. And again, the allowable base is determined as a function of the person's income, filing status, and so forth. And I'll walk through a calculation of this as well. And these are for taxpayers who are over 65 or permanently or totally disabled. Permanently and totally disabled. So the allowable basis then for the elderly tax credit, $5,000 for single, goes up to $7,500 for joint when both spouses qualify, or $3,750 for married filing separately. So we need to calculate the base amount, and this base amount is reduced by any non-taxable Social Security benefit, and then 1/2 of that amount, the amount that AGI exceeds the allowable base amounts. So for example, if we have $7,500 for a single, $10,000 for joint filers, and $5,000 for married filing separately. And again, I'll walk through the calculation for this credit as well. Well, let's look at one here on PowerPoint. Joe and Sue are married and file a joint return. They're 70 and 60 years old respectively. Okay, so remember that they have to be over 65. So we'll go back here. This credit's for folks over 65. In this example then, Sue would not be qualified for the credit, but Joe would be since he's over 65. They have AGI of $12,000 and receive non-taxable Social Security benefits of $1,500. So the base amount, as we said, is $5,000. And we'll slide back up here. That's for single taxpayers or only one spouse qualifies, which is the case in our example. So that's our starting point. Now we're going to deduct from that the non-taxable Social Security of $1,500, which is given to us, and then half of the AGI over $10,000. So they're telling us that the AGI is $12,000. That's $2,000 above $10,000 limit. And then we'll take half of that $2,000, which would be $1,000. So again, $12,000 minus $10,000 is $2,000, and then take half of that. So we started with 5. We'll reduce it by the $1,500 for the Social Security that's non-taxable, and then half of the AGI that exceeds $10,000. So finally we arrived then at our allowable base amount. And this allowable base amount then is the amount we apply the 15% credit to. So 15% of the $2,500 allowable base, very much like a modified adjusted gross income concept, gives us the $375 credit for elderly or disabled. Another credit is education credits. There are 2 at the federal level. They are the American Opportunity Tax Credit, AOTC, also known as the Hope Scholarship Credit, and then the Lifetime Learning Credit. Both allow credits for higher education expenses. So the AOTC, that's the more generous one. That's for the first $2,000 of qualifying expenses, tuition for example, and 25% for the next $2,000, for a maximum of $2,500 per student. So for example, if a taxpayer in their second or third year, for example, of college, incurred $4,000 of tuition expenses, then their credit would be $2,500. $2,000, the first $2,000 plus 25% of the additional $2,000. The lifetime learning credit is not quite as generous, but it does apply throughout the taxpayer's lifetime, whereas the AOTC only applies to the first 4 years of college, and a taxpayer cannot use both expenses. So the lifetime learning credit is 20% of qualifying expenses for a maximum of $2,000 per taxpayer per year. The AOTC above is $2,500 per student per year. Here it's per taxpayer per year. So as I said, it's not quite as generous in amount or in terms of the number of potential dependents that may qualify. They, like many credits and some deductions, phase out when modified adjusted gross income gets too high. So the phase out for the AOTC starts at $80,000 for single filers and double that, $160,000 for married filing joints, respectively. Now single filers and married filing joint phase out completely when these amounts reach $90,000 and $180,000 respectively. So another way to put this is the range for single filers is $80,000 to $90,000. The range of phase out for married filing joint is $160,000 to $180,000. The lifetime learning credit also has phase out provisions. Phase out of modified adjusted gross income amounts of $58,000 for single filers, $116,000 for married filing joint, and then the upper end of the range goes from $68,000 for single to $136,000 for married filing joint. And there's a $10,000 range for the single filers and a $20,000 range for married filing joint. Once again, if the taxpayer reaches modified adjusted gross income of more than $136,000, then the credit is not available to those taxpayers. So in terms of formulas, this is what the formula looks like. Here are the ranges I mentioned earlier. $20,000 range for the phase out, for the AOTC, American Opportunity Tax Credit, and for the single it's $90,000 minus the MAGI, and then divide that by the $10,000 range. And this will give you then the amount of the phase out. Lifetime learning credit calculation is very similar, different numbers of course, but again we have the $136,000 minus MAGI divided by the range for married, and same is true for single taxpayers. And you can see the phase out range is a little bit lower for the lifetime learning credit than it is for the American Opportunity Tax Credit. Another credit that's available, and again these are dollar for dollar reductions, is a foreign tax credit that's available for taxpayers who pay foreign income taxes. For example, if they earn some income in the U.S. but earn more additional income in another country, then the extent to which they pay taxes in that other country, they may receive a credit up to a certain limit against their U.S. tax liability. Another big one, and this one's gone up in recent years, is the child tax credit. And this is available for taxpayers who have children under the age of 17. And there are restrictions. They must be a U.S. citizen or resident. The child must be younger than the person claiming the credit and unmarried. So the credit is up to $2,000 per child now. It does phase out when AGI reaches certain limits. Now the credit is refundable up to $1,400 per child. Now what that means is that even though the taxpayer gets a $2,000 credit for each child, if that credit creates a refund, then only up to $1,400 of that can be refunded. So there is a limit. Some of these, in fact, many of these credits may not create full refund. But if the credit, the refundable portion, exceeds $1,400, then that will not be refunded to the taxpayer. And then there's a $500 non-refundable credit for qualifying dependents other than kids, other than their children. This child tax credit does phase out at rather high AGI values, $400,000 for married, $200,000 for all of their taxpayers. Now this phase out is calculated a little bit differently, and I'll demonstrate this one in the assignment as well. The credit is reduced in these $50 increments. So for every $1,000 that the AGI exceeds these thresholds of $400,000 for married, for joint, $200,000 for taxpayers, there's a $50 reduction in the credit. So let's run through an example here. If a single taxpayer has adjusted gross income of $217,000 and one qualifying child, his or her tax credit would be $1,150. So let's look at this. The credit for the one child will max out at $2,000, as we stated earlier. But you'll notice that the AGI is $217,000. That's $17,000 above the minimum range, so $200,000. So that's $17,000 over the low end of the threshold. Therefore, 17,000 divided by 1,000 is 17 $50 units. I'll say that again. We have 217,000 of AGI. That's 17,000 above the $200,000 limit. And so that 17,000 is divided by 1,000. And we have 17 $1,000 that it exceeds the limit for phase out. We know that with each $1,000, we're going to reduce the credit by $50. So $50 times 17 is $850. So the one child initially qualified for a $200,000 credit will take off $850, or $50 times 17, and that will give a final result in $1,150 credit for that child. Another credit that's available is to encourage lower income folks to save for their retirement. And this is called the Retirement Savings Contribution Credit. So if a taxpayer makes contributions to a qualified retirement account, such as an IRA, traditional IRA, Roth, 401k, 403b, 457 simple and SEP plans, or other qualified, well, when we make qualified, of course, we mean that plans that are recognized for tax purposes by Congress. So credit is based on a percent of the contributions made. The maximum amount of contributions for credit purposes is $2,000 per person. And we again use the modified adjusted gross income to determine the amount to apply against the percentage. Another important credit for many taxpayers is the adoption credit. The credit is available for 100% of adoption expenses. The credit is available for up to $14,080 per child. Payers generally must file a joint return, though, to get this credit. So this is one of those limitations that are often imposed on various types of credits and deductions. In this case, the taxpayers generally must be married. How married is defined is determined at the state level. Federal government doesn't get into that. If one state recognizes marriage as being something other than a marriage between a husband and a wife, a male and a female, then that state would have a broader understanding or definition of what married means. and then the tax law would apply against the state's definition of marriage. By the way, this credit, like many other credits and deductions, are adjusted or indexed to inflation. And then another really important credit is the earned income credit. This credit is often underused by low-income folks who work. It is fully refundable. This is one of the very few credits that is fully refundable. So in other words, if a taxpayer had earnings and their deductions took them to a zero tax liability, and then they applied for and qualified for the earned income credit, they would receive the entire credit as a tax refund based on filing status, number of qualifying children, and earned income amounts. So this is for earned income, though. It includes salaries, wages, tips, earnings from self-employment. In order to receive this credit, the taxpayer must have a qualifying child or meet certain criteria. So you generally have to be a qualifying child. Generally, that means a dependent to qualify for this fully refundable tax credit. This earned income credit can be phased out above certain income levels. And if the income, which is mostly investment income, that's not earned income, investments such as with stocks and bonds and savings accounts, is in excess of $3,500, this will cause that taxpayer to be ineligible for the credit. So if someone is earning a lot, maybe a small earned income at their job, but they're receiving considerable unearned income, investment income, then that can cause them to disqualify for the earned income credit if that exceeds $3,500, that investment income. So here we see the earned income credit amounts. For a child is $35.26 maximum. For children, $58.28. That's for 2 children, and then 3 or more children is $6,557. Again, fully refundable. No children, there is in some cases earned income credit allowance of $529 for taxpayers. Another tax credit is the premium tax credit. All individuals are required to either have health insurance or qualify for an exemption. So this is for folks who are low income, near the poverty level, or 1 to 4 times the federal poverty level. They can receive a tax credit for paying these insurance premiums. In the next video, I'll run through some calculations then that will help to fortify our understanding of some of these concepts.